Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player.
Good weekend, all. Ira Epstein, after a crazy week with your weekend edition of your financial wrap-up, and this is for Friday, October 12th, 2018. We're just after 3:20, but this will be where the stock indices will settle. They'll trade for another half hour after 3:30, but the settlement's still going to come in there. This is about where you're going to finish up in all the metal markets as well. And we'll notice that the bonds and the notes are given a little slippage. They'll probably settle actually higher than that. That's where I saw them at that time. Now, there's something that is interesting that's going on, and you can read an article in Barron's this weekend. I think it's written by, I think it's Robert W. Forsyth, but the last name's Forsyth, and he covers an interesting part of interest rates to the stock market and brings to light a watershed event, as I like to call it, where in the past, the stock market would go up, the Fed was raising rates, you'd back off, the stock market would charge higher, the Fed kept raising rates. We've been in that pattern, as you know, for about a year and a half, whatever. We're now at a different point. Now the stock market is falling as the Fed's raising rates. They're opposites each other right now. So as the Fed's going to raise rates, the stock market gets hit. It's not working where they're in sync together at all. They're out of sync, and that's probably how they're going to stay, according to this article. Does it still mean the Fed is accommodative? You want to read the article. So I thought it was interesting enough. I've never met the man, but I enjoyed the article quite a bit. So in looking at the markets now, you know how volatile the week was. We finished up today with a bounce. That doesn't mean you're out of the woods by any stretch. Dollar had a bounce today at the expense of the euro. And of course, on Brexit, we don't know where we're at. And that is the problem that's overhanging that particular market. Now, as you take a look on a monthly area chart of closes, it's been a heck of a long time. And with our new charts, we can go back very, very far. These are new high-definition ones that we have. And you haven't hit the 18-month moving average of closes since back in 2016. Is this the time you're going to do it? I wish I could answer. I don't know. When I come to the weekly area chart of closes, you're under that 18-week average. So take a look. The last time you did that was all the way back here in May of this year, and it began that break in February, if you remember, when we got up and then the market just had a big crash and then came back. For those of you that are Fibonacci fans, let's put on a Fibonacci study. If we go back to that February time frame and we mark the low and go up to the recent high we just made, this gives you an idea where you're at. You're at a 50% correction in the market. Is that normal? Yep. Is that abnormal in any way that it's stretched too far? Nope. So you're getting into the bands. These red bands represent the typical Fibonacci. First retracement, second, third, if the market's going to stay within there, all measured from this low to this high. Pretty hard to argue with as I see it. When we take a look at just how the market is in swing lines, you stepped out of the trend. If I come back like this, you had this pattern of higher lows. It was very simple to see. Higher highs, very difficult for traders to get in if they were trying to buy on breaks. That was the problem. Now you get the break and everybody's saying to themselves, and it's interesting as can be, well, maybe that's the end of the whole move, and it might be. Maybe this is where on the rallies you bail out, it might be. But if we go back to February, and I just got to take you there, were you asking the same question on that break? That's all that I'm trying to bring forward as a chartist. When we look at the moving averages, as I said, you're under the 18-week average, so the bias of the chart is down. We have a market that stepped out of its trend. The bias is down. Further supports down at the 100-week average and the 200-week average way down here, very, very far away. The Bollinger Band number is 2714, let's say 50. You got down to 27, 12, 25, and from there you've bounced 50 points off of that to be back up in this general range right through here. So what we know is the first challenge of the Bollinger Band held. Resistance if the market keeps rallying, the 18-week moving average of closes, and momentum is turned down. So what you have is a market that stepped out of the uptrend. The bias is down since you're under the 18-week average, and momentum is pointing down. A downside target has already been hit in the lower Bollinger Band. As we step into the NASDAQ, it is very similar. If we go back a week, we had a market that got up to its upper Bollinger Band, fell, and came down rather hard. If you take a look, the 18-week average was 73.91.14, and the high, or the low that week, was 73.47. So you went from high to low. This week, you went down to the lower Bollinger Band again. What's the importance of Bollinger Bands? 95% of the time, the market will trade within them. And one of the things I teach in my charting course is the first time you hit them, be it to the upside or downside, often. I wish I could use the word always. That's not the right word, though. Often, it acts as an initial support or resistance point. And pros, what I've learned, the pros that use Bollinger Bands have a habit of stepping out of the market on some, all, whatever of their positions. It is not an add-on position area. When you step to the Dow, you can see how the market this week got under the 18-week average of closes, momentum pointing down, not as weak as the other indices. Didn't get down to its lower Bollinger Band. The Russell has been in a free fall. This has been the leader all the way down, especially on the daily charts, which got what we call the embedded reading. And it was the only one to have it bearish, and it just kept it. And as it turns out, it was the lead index to the downside. And this market is still very much in a free fall. You've gone from 1746.30 down to a low this week of 1530.75. What else? You're 2 weeks now under that lower Bollinger Band. Last week, I think you finished at 1639.40, just under the 1640.05 Bollinger Band. You're now under it again, as you're here at the 1549.30 level, well under the 1601. So that's 2 weeks in a row down. Now, a rule of thumb I developed in my charting course is each consecutive week or each consecutive day that you're under or over a Bollinger Band takes away one of those percentage points each time. So now if there's a 5% chance you'll stay under the Bollinger Band, now I take it down to 3. You should ask what happens if you go beyond it, and my answer is you go behind it. The idea here isn't to get long for the bounce. The idea is if you think the trend is still down, where can you get in better? Or the idea is when you're under a Bollinger Band, where do you consider possibly taking some money off the table? In the VIX, we've done similar to what we did back here. They look the same. They're coming out of the same patterns. I think you'd agree with that. So what happened? Well, back here you had a big spike up and then you came back. The difference is that what? We were raising interest then. We're raising interest rates now. I don't know that the difference is that much. I've looked at it all. We're just recognizing that the Fed's in this mode and we've accepted it. So it'll be curious. I'm not predicting anything. The trend is up as the trend picked up here. The same way. The swing lines turned up. The swing lines turned up. Will it result with this market coming back down? And we all know when this market came back down, the stock market took off again to the upside. I am not saying that's going to happen. I'm pointing out what happened, past tense. In the 10-year notes, what I'm seeing is that the Fed is determined for a December rate hike. I don't think the stock market break has taken them off it. I see that we had sideways action, and we have broken out to the downside. Now, the settlement is going to be, as I told you, higher than 118.04, so you're going to be higher than this lower Bollinger Band. So while the market had several weeks in a row under this number, if you take a look, now all it's done is move to the right-hand side. It's still very much in the camp where it's riding the lower Bollinger Band, which is bearish. The pattern is not one that's on the weekly charts it traded because you had a higher high and a lower low. But when you break out of sideways action, this is the one thing I've been telling you even on the daily charts, you have to get oversold or overbought in the process. It's what happens. And That's now in the weekly chart, we don't ever look at oversold, overbought. We just look at momentum. The momentum is down. The bias is down. The market gave us a bounce this week. In TLT, if you take a look at where the market's at 114.47, that's the settlement. You closed, if you look, just under it at 114.36. You have a week down here. This week you finished the week off at 113.04, under the lower Bollinger Band again. That was 2 in a row. Here's 3. This one you were over it. I believe you were over it. Let's just check. 117.10. No, that was 4 in a week down. So you got 4 in a week down. The odds favor that TLT is going to move to the right-hand side. No, the odds don't favor it's going to get bullish. That could happen. But the trend is down here. You got lower highs, lower lows, but getting too far away from that Bollinger Band, I'm not expecting it. In the dollar index, notice the battleground is the 100-day and the 18-day average, weekly average of closes. I'm so used to saying the day. That's your battleground in sideways action right now. In the Eurocurrency, the market broke down this week, got down to 114.93.5, took out this low. So the market had been in higher lows, higher highs, ran up, and I'll bring this to you, ran up to the upper Bollinger Band when it did it, stalled out for all purposes right there, and has pulled back underneath it to the 100-day average where the market is fighting a battle. Has not come back to the lower Bollinger Band. Momentum is flattening out on this. It's not pointing down. It's sort of flattening out while the bias is down. In the British pound, we've had a pattern of higher lows, higher highs. You've gotten to, and you have been fighting for 1 week, 2 weeks, 3 weeks, 4 weeks, 5 weeks. At what number? The 18-week moving average of closes. This is a market that doesn't know what to do. It's trying to figure out how does it break out one way or the other. I think next week we might get more clarity both in the chart and how is Brexit going. Supposedly we're going to see something delivered. I don't know what that something is. In the Canadian dollar, the market on the weekly charts had gone all the way up to the upper Bollinger Band as word, and go back with me in time, as the president and Canada got together, finished up the old NAFTA deal with the new Mexican, Canadian, American deal as we've got it. And away we go with this market. So this looks better. We get the old buy the rumor, sell the fact as the market pulled back on you. In the Japanese yen, need I tell you that the market's had a bounce because of flight to safety. And the market bounced away from what point? The lower Bollinger Band as momentum's turned up. Sizable resistance is waiting for this market between let's just say 90.07 or 90.01, right there. The combination of the 100-week and the 18, the red and the green. So this market will be interesting there. Bitcoin has been fighting a battle on the 18-week average of closes, but the bigger picture is all the sideways action. Is that going to lift or break the market? We now have a long period of sideways action. From that period comes a trend. Is the next trend down where this market heads towards the 3,000 level? Is the next trend up where the market looks back and said that was your opportunity to get in and the market's going to move out to the upside? In the energy markets, we had gotten as high as a differential of 10.98 in the Brent versus the WTI crude. We did that all the way back in June, if you look. From there, you went down to $2.61 differential. We shot back up to 9.82. We're back to 9.02. The market is in an up thrust as each break low so far in this thrust hasn't taken out a prior one. If you take out this low of $8, you might be headed to the 675 level. It hasn't done it, so Brent is still stronger. And yes, the market is respecting the upper Bollinger Bands. There was an awful lot of talk was this market was up last week and the week before. $100 crude oil. It's coming. It's coming. Those people have been left now with the market down on them from this level of nearly $87. You just got as low as $79.22. I'm warning you, don't pay attention to the news. Don't pay attention to these guys. By the time they're telling you 100 and it's up at the 80s, it's news that, I don't know. The weekly bar chart on WTI, support comes in, 69.95. You've got a pattern of higher lows, higher highs. You ran into the resistance level up here at the 75.20s, and you've backed off. We'll see how it finds support there. Gasoline market's got a pattern of lower highs, lower lows, and it has hit its downside target. You understand? From this point on, it gets dangerous to keep breaking it. Why? Because you're under the Bollinger Band, and you only stay under that number 5% of the time. Momentum down, bias down, trend down, and you've hit a downside target. Can you go lower? Of course. Resistance point, 206.20. Natural gas. Natural gas has had a big blip up, and now the market is pulling back. We're at 315. If you take a look, you're literally right on the upper Bollinger Band. So you spun over that and you ran out of your momentum. You almost see that, how this is moving there. Now we are going to enter a time frame now as we get to the end of October where, according to the EIA, we're going to be entering a period where we've got less natural gas on reserve than we have in the past 13 years. Let's hope that it's a mild winter, because it could drive prices higher if it gets very cold. Pattern up, ahead of itself, may be ready for a bit of a pullback. You know, I talk about all this, and I've already begun writing my report for the weekend. I begin at Friday afternoon, and then Sunday, after a couple of wines, I finish everything up, and I try to enjoy what I'm doing. And I think you'll find the way that I write is simple. I don't write page upon page. I bring you in with the details you need. What I believe in really giving my subscribers that want trade ideas is letting them see my morning video. Those that want the commentary, read the commentary. You're going to be able to read this in a couple of minutes, but I'm going to bring out what the market's looking for the next day on reports, trade estimates, my own take on what's going on at any point in time. I put out at least an update morning and afternoon, Monday through Friday, well, Monday through Thursday, Friday morning, at least one. If I see something special, I'll write another one that day, and then I start again Sunday night with an update. Besides my research, our company puts out a massive amount. We all tie it together. We all read each other's things. So how do you get this? Give us a call. You can go to our website to sign up for the free offer. You can click here. It'll take you there. I'm Ira Epstein. You have a great weekend. I'll see everybody Monday.